Hey, good morning, everyone. Marty Missouri here. It is Friday, 22nd of April, 2022, with your weekly economic update. Coming at you a little less actually than an hour before the close, about 50 minutes before the market closes. It's 12:09 here on the West Coast. And the market's having a rough go of it for the second day in a row as I speak. Looking at the S&P is down 2.5%. Nasdaq's down almost that much. The Dow is down about 2.5%, 861 points as well. So I'll cover that at the end, and I'll just kind of help you put this action into perspective. But first, the overall economic update. So third week in a row where we didn't move, 12.77 on our index. So while growth is slowing, we're still not to the point that we would call recessionary conditions, or the point where recession odds going forward outweigh the odds of continued expansion. I would concur right here with the data, although a lot of worries about what could happen going forward in a world where the Federal Reserve is essentially reversing course, frankly, in dramatic fashion, if you believe what they're signaling. And that is very problematic, as we're starting to see, or maybe starting to realize, with regard to the market. But again, we'll get to that here in a little bit. We did have inputs that went down, but we had offsetting inputs that went up. But what we'll do here is just run through the handful that I think are worth looking at today. There's 47 in total. And each week I show you sometimes the same ones, over and over again, like commodities, which we're going to do here again today. But I try to mix it up a little bit, and within here you're seeing also the ones that move in terms of scoring. Housing starts here in the U.S. actually went up this last month. That was just released. And so that would be bullish. I mean, that would be positive. However, the breakdown was in favor of multifamily, 5 units or more, versus single family. Single family starts actually declined a bit month over month. It was multifamily starts, of course, with these crazy high rents that landlords are being able to charge these days. Well, then that inspires building of capacity. That old saying, higher prices are the cure for higher prices. If you expand capacity and there's more to choose from, well, then competition would ultimately force prices down. So that makes sense. We're seeing that impulse in housing starts, and we're seeing that in housing permits as well, meaning that we have that same story where there was a tiny uptick month over month overall, but it was a bit of a downtick in single family permits and a bit of an uptick in multifamily. The housing index, I call it the home builder confidence index, that also came out this week, and it came in at expectations, which is a further decline down to 77, which was the lowest since September of 2021. Present situations component fell 2 points, but 3-point increase for expectations. Of note, and I'm reading from Peter Bookvar, the Economist notes, prospective buyers traffic fell 6 points to 60, the slowest since August of 2021. The chief economist of the NAHB put it simply: the housing market faces an inflection point as an unexpectedly quick rise in interest rates, rising home prices, and escalating material costs have significantly decreased housing affordability conditions, particularly in the crucial entry-level or first-time homebuyers market. So that should be no surprise to anybody. We are still seeing real resiliency in some of the underlying fundamentals, but you have to question, the rate of change of home prices, where things are going from here amid these high prices and higher mortgage rates, of course. So folks, again, economic overall conditions are slowing. However, you would not know it by the weekly jobs data. Jobless claims are just at hugely historic lows, and I say this every time: these are not adjusted for rising populations over time. And the continuing claims, same thing. I think we got to go back to the 1960s or something, right, to get continuing claims, and for that matter, initial claims, as low as they are currently. And yesterday, Jerome Powell said it's essentially, quote, too hot right here, or inflationary. And so, while, as I've said over and over again, I'll get into a little bit more of this in a minute, equity market actors in the aggregate just do not believe, based on what they've experienced the last 12, 13 years, that this Fed will indeed take the kind of actions that would do serious damage to the price of stocks. They've been ultimately concerned with the wealth effect, and when people feel wealthy, they go out and do stuff. Well, when people go out and do stuff right now, it fuels inflation. So if you listen to the individual Fed governors to speak of late, they're talking about things like the stock market needs to come down a little bit. They need tighter financial conditions. The big question is how much pain are they willing to feel as it relates to financial markets? And that, of course, remains to be seen. But the action, at least here in the last couple of days, suggests that perhaps finally equity market players are beginning to believe that maybe this Fed will allow equity prices to fall, that maybe there's still a Fed put under the market, but it's way lower perhaps than what it was, say, a year ago. And I think that's a very logical conclusion. As I keep saying, this market, in terms of equities, is just not discounting remotely what the Fed is threatening. It says optimistic things when companies are willing to borrow, right? These are commercial and industrial loans. So you see that nice pickup there month over month. The leading indicator to coincident indicator ratio, that one's concerning me because that's a very good indicator. It has been long term, and that's rolling over. So it goes lower when leading indicators underperform coincident indicators, and that's what we're beginning to see as some rolling over here. So we need to keep a very close eye on that. There have been some false signals over time. This may very well be one. There were two, and we talked a lot about this here on the video while these were going on over the years, or at least looking back at these. And I remember in here, we actually went negative in our index, and I was pointing to this, and I said, folks, my best guess is we're not going to see a third false signal here. And sure enough, of course, COVID helped that scenario out. We didn't, but you can see here, it was just one and done before the big recession in 2008. Couple here, and then the third one was all she wrote here. So anyway, again, here it is back here. Again, something to pay very close attention to, and get into the internals and look at what that's all about. Commodities, I keep promising some corrective action. Well, we've had it this week, and it's being exacerbated today. There's just nothing really that's up today, save for, ironically, Chinese equities. Even precious metals, we're seeing it across bonds even. We're seeing it across equities globally. With that, with the exception of China. Of course, China's got idiosyncratic issues, to put it mildly. And then last but not least, with regard to our economic update, this is the ratio between staples, XLP is our consumer staples ETF, and discretionary stocks, and that's XLY. So when this goes up, staple stocks are outperforming discretionary stocks. And again, staples are things that you gotta buy if you want to live. Discretionary items are things that you are going to buy when you're feeling good about your economic prospects. So when staple stocks are outperforming discretionary stocks, that implies that the equity market is beginning to discount perhaps some coming weakness in the economy. So if we take a longer look at this and we kind of zoom out a ways, let's go back to the mid-90s. We can see this is actually a fairly decent indicator, right? Here, all of a sudden, right, early 2000, staples started really outperforming discretionary. Of course, that was amid tech beginning to fall apart. And then we had our recession in 2001. Here it was starting to ramp up right before the great financial crisis, the recession of 2008. And then slowly but surely moving its way higher. Remember, we started hedging in here because our index turned south, but you can see that there was a rising trend in staples outperforming discretionary stocks. And folks, we've been seeing it here ever since late 2021. And so again, just another check mark in terms of our concerns. We don't have all our boxes checked, for recessionary conditions, but this is one that we do, at least at the moment. Of course, there's volatility in here too, right? With everything, nothing's perfect, and you don't get overly excited. It's a combination of factors that you bring into play to make a determination of what probabilities would say. So this one would not be bullish for the economy, at least here at the moment. Okay, so let's jump in for a minute or two on the S&P 500. Here's that 60-minute chart. So remember, we had this bullish falling wedge. We had our divergences, and then we broke out of that. And boy, did we roll over hard yesterday and then again today. And there's nothing here other than being oversold at the moment on the hourly chart. And it's kind of what the day has been when we looked at like the 5-minute chart, is just get these rallies and they get faded. Since I've been talking, the S&P rallied for a little bit, and it's getting sold a bit right now. We'll see if we get a rally the last half hour. So no, there's nothing that would be actionable here on this chart. On the daily chart, okay, so we don't have any real divergences here on the momentum indicators. Just zooming in here. Yeah, not a good look. Remember, a few weeks ago, I drew this support line and suggested if we break through that with some momentum, we've got problems, right? Well, we have a very classic looking bear flag, in my opinion. So you had a nice big sell-off. You consolidate those losses as you kind of turn back in a counter trend rally, and then you roll over again, and then you have a price target that would be the length of the flagpole. This right here takes us back to, all the way back to, it was real resistance back here in April of 2021, and then in June and July. So yeah, you break through here, you have a little support there, and then from there, you got quite a bit lower. And remember what I keep saying almost every week, folks, our base case is that this market is likely to explore some lower depths before 2022 actually plays itself out. At least that's what we're seeing in the charts. And let me show you what the weekly one looks like today. So recall that we have this going on in here, and I showed you, 2 or 3 decades back, that when we came down, see the green line in there, when we came down below that 50-week moving average, retested it and then lost it. Without exception, we came down and tested the 200-week moving average, and in a bear market, we penetrated that, and it got even worse. So that's looking all the more likely as these weeks go by. You can see the last 2 weeks anyway. So a close below there this week would be decidedly bearish, but lots going on in the world. So yeah, I could give you several potential scenarios that could see people rush in and buy this thing right back up. The charts are suggesting, though, that probabilities, for what it's worth, and I'll be here to tell you when they change, are pointing to lower levels going forward. But time will tell. And then lastly, take a look at the monthly chart here. Yeah, so here we are, 2/3 through the month, and we're looking at a candle that's kind of falling apart here, and technically it's actually engulfing the last 3 months. So the bulls do not want this to close with a body this big. That would be an engulfing candle, and that's notably bearish if you're a technician. My concern, though, is this look here. Again, I keep showing you this, but when you have a sell signal on the monthly MACD, which is very slow moving, and I've circled all of them, the last 25 years, you have a notable double-digit decline. It was 20% here in 1998. Now, that was the only one that didn't come down and test the 50-month moving average. You can see it came and went. But when they came and stayed, you came down here and you at least tested. You broke it, of course, in the big bad bear markets. But at a minimum, when you've had these, you broke down and you tested it. You broke down and you tested it. You broke down and you tested it. You broke down and you haven't tested it yet. And there's, a good 800-900 points from here to hit this level. And that's an additional 20% from where we are right now. And that would give us a 30% decline on a year-to-date basis in the S&P. So I need to continue to remind you, this is what the charts are pointing to based on patterns and our work over the years. From a fundamental perspective, or from an overall macro perspective, we have a Federal Reserve that is trying to signal to the markets that it's not going to be there to support it. The market, if you will, players in the aggregate, haven't wanted to believe that, because that buy the dip mentality, has been working for 12, 13 years. That's going to be hard to get rid of. And it's showing up in things like fund manager surveys that players who can wield some serious money and have an impact on stock prices still just don't believe that the Fed is really ultimately, when it's all said and done, is going to pull the punch bowl. My contention is they may be right, but I think the party has to crash, and that's kind of what we're talking about. So that's this push and pull of the market. Yeah, market players are probably right. The Fed will probably rescue the market, but not here, right? It's got to be at much lower levels, particularly when they're contending with the kind of inflation that these Fed characters have never had to contend with. And now that's the pressure. That's certainly where the political pressure is you got to do something about inflation because people are seriously hurting. And we've already given away the farm in terms of stimulus. At the end of the day, sure, these could fail, these patterns, the market could go higher. But using my latest favorite analogy, unequivocally, while I don't know where the market's going tomorrow, I can tell you that the ice on which it is skating is thin right here. So, be careful out there, folks. Thank you, as always, for watching and listening. Hope you have a great weekend. Bye-bye.